Welcome back to Trading with CJ, and if you haven't seen my channel before, then I talk all things stock market, investing and personal finance. I also have an Investing for Beginners series, and as part of this series I think it's important that we cover some basic investment terms that you may not be familiar with if you're new to the investing world, or if you already invest, then you definitely should know. Now these aren't going to be particularly long videos, but I feel like it's definitely important and they should be included in the beginner series. So today we're covering PE ratio, which basically means price to earnings. And this is one of the most common terms that you will come across when looking into a company's key ratios. Now the PE ratio is used to give you an indicator as to whether a company is maybe overvalued, undervalued, or maybe there's some issues within. So what is PE ratio? Well, as I said, it means price to earnings. Now the price part refers to the price of a company. How much is one share of a particular company? So to give you an example here, we're just going to put up Coke. So if you was to buy one share of Coke at the time of recording this, it would cost you about $50 roughly. So that's its price. Now we want to divide that price by their earnings. Now we can find their earnings by looking at their EPS ratio, which stands for earnings per share. And we can see that Coke's EPS ratio is currently $2.18 per share. So if we divide the share price by the EPS ratio, we now get a PE ratio of 23.42. Now the PE ratio will change on a daily basis because the price of the company, aka the share price, is also changing on a daily basis. Now if you wanted to find out how to get these key ratios, most of this is online, especially if the company is public. You will just type in on Google or whatever, Coke key ratios or Coke PE or EPS ratio, and it will all just come up for you. Nowadays you don't really have to physically go in and work this out, but nevertheless it is good to know what these mean. Just to give you another explanation here, another really simple example, if I had a small business and it was making me £100 revenue per year and £90 of that was my expenses, that means I've made £10 profit. 100 minus 90 is 10. And if somebody wanted to buy my business, and let's say I said I will sell it to you for £200, that means I am valuing my company at £200, 20 times my earnings, which makes it a PE ratio of 20. So now we know how to work out a company's PE. What does it actually mean? Well, as a general rule, the higher the PE ratio, the more overvalued a company is at its current price. And the lower the PE ratio, the better the valuation. Now, unfortunately, it's not necessarily that straightforward. Sometimes a really low PE ratio could indicate problems within that company. People have less faith, therefore they're selling shares. Maybe there's problems ahead or bankruptcy looming, something like that. So to give you an example of a company kind of similar to this, if we look at Wirecard is a German payment processing company. It's currently trading at 0.70 euros per share. And if we look at their PE ratio, it's 0.20, which is extremely low. And the reason for this is the fact that they've had so many problems this year. They've lost a huge amount of money, just went missing, and they're pretty much been on the brink of bankruptcy for the last few months. So just because you see that it's got a really low PE ratio, it does not necessarily mean that it's a good buy. So this is why you should always do your research, read up about the company, have a look at news surrounding that company, because you don't want to be catching a falling knife. Now on the opposite side to this, just because you see a company with a really high PE ratio, it doesn't necessarily mean it's a bad buy. A lot of the huge tech companies out there have really high PE ratios. And that's because a lot of people are buying up those shares because they see extremely high future growth. So whilst it might be overvalued at its current price, it doesn't necessarily mean it's a bad buy. So if we look at an example of this where maybe people are buying it based on future potential, if we look at Amazon here, they're currently trading at around about $3,400. So it's a really expensive company. But if we look at the PE ratio, it is huge. It is one of the highest PE ratios I've seen, currently at 139. So it's valued at 139 times what it should be at its current earnings. So the same as with seeing the companies with extremely low PE ratios, it doesn't necessarily mean a higher PE ratio is a bad buy, because the future growth may already be priced in. But if you are looking for an investment where at its current prices you're getting a lot more value for money, then a lower PE ratio could be a good indicator of that. But with that being said, do not base your whole investment on the PE ratio. The PE ratio is only there to give you a slight indicator of how the company is currently valued. If you are planning on investing into the stock market, you should always do your own research into these companies. So I hope this has helped, and let me know down in the comments below if you've come across any other terms before that maybe you're not familiar with. I'm happy to either make a video on it or just reply to your comment. Let me know down below. And if you have found this useful or interesting, please hit the like and subscribe to my channel. It really is appreciated. Thanks for watching, and until next time.